Welcome to our webinar on the tax consequences of emigrating from South Africa. I'm Victoria Lansfield, and I am a global tax specialist at Sail International. Today, we'll be discussing all the ups and downs of leaving South Africa and how it will affect you from a tax perspective. We encourage active participation in our webinars, so please feel free to submit your questions in the chat throughout the webinar, and we'll address them at the end during the Q&A session. We will also be conducting a few polls throughout the webinar to gather your insights and opinions on various topics, so please do take part. Before we dive in, please note that the information provided in this presentation is generic advice. For specific tailored guidance, we strongly recommend seeking further professional advice. Any reference to legislation is based on Sail International's interpretation and as of the date of this webinar. Okay, here are the topics that we will be discussing today. We will start with determining tax residency in South Africa. How is it determined? What makes you tax resident? What doesn't? Then we'll move on to the application of a double tax agreement and its rules. We'll look at how to protect your foreign income from SARS and South African taxation, the process of breaking your tax residency in South Africa, and then the drawbacks and benefits of seizing your tax residency. We'll speak about other jurisdictions and how tax is treated there, and then other considerations that might happen with breaking your tax residency. And then finally, we'll close it off with those of you that were returning to South Africa after migrating and what to consider. We will start with a poll. So please try to take part. I'm going to launch it now, and I'll give you guys 30 seconds, and then we will look at the results. All right, thank you, everyone. I'm seeing a bit of UK, South Africa, Australia. Let's give it 10 more seconds. Got someone in Ireland. Wonderful. Thank you all. Let's move on with the presentation. Great. So let's start off today with chatting about how you determine to be tax resident or not in South Africa. Firstly, I'd like to speak about the fact that a tax residency is not the same as your visa or citizenship or permanent residency that you're on in a country. It has to do with how a country will or jurisdiction will consider what to tax you on. All right, so I just want to make that very clear that a tax residency is not necessarily the type of visa or citizenship that you're on. Okay, so to effectively manage international tax matters, it's crucial to understand the varying approaches different countries or jurisdictions take on taxation. There are three main tax systems, being residency-based tax system, citizenship-based tax system, and a source-based tax system. The residency-based tax system taxes individuals based on their tax residency status. Tax residents are required to report and pay taxes on their worldwide income, whilst non-residents are only taxed on income earned within the borders of the country. Each country has their own set of rules or criteria that determine your tax residency status. Citizenship-based, on the other hand, is a tax system that determines your individual citizenship rather than the place of residence. So that's where your passport will be important as to how you're taxed in that country. There are actually only two countries in the world left that still use this tax system. That's Eritrea, and the United States is a big one. So, for example, you live in the States and you've got your citizenship, then you go and you live somewhere else around the world, but you still maintain your US citizenship. That means that you'll still file and pay taxes on your worldwide income to the States, irrespective of that you live somewhere else. All right, so that's different to the tax residency one that we spoke to begin with. This is to do with your citizenship. The third one is the source-based tax system. This is what South Africa used to be prior to 2001. This system focuses on the location where the income is generated or sourced. Individuals are taxed only on income that is earned within that country, while income earned out of that country is generally not subject to tax laws. South Africa is a tax residency-based system, meaning that you're a tax resident or non-resident based on meeting certain criteria and certain tests, and on that you're then taxed accordingly. A tax resident in South Africa, it's taxed on their worldwide income, not just South African, and a tax non-resident is then only taxed on any South African income, if they have any. Now, the different thing about the South African tax system is that the burden of proof lies within the taxpayer to demonstrate any change in their status, meaning that even if you meet all the criteria to break your tax residency, it's not automatically changed. You need to apply a formal application with FAS to have your status changed. As such, in South Africa, if you're noted as a tax resident, you are subject to tax on all your global income, even if you've broken the residency tests. If you haven't changed your status, you still need to declare and pay tax on your worldwide income. Right, let's move on to the next slide. Now we're going to discuss on what factors are considered to determine your tax residency, if you're resident or non-resident. South Africa has two main tests that determine tax residency. They're written in legislation. The first one is the ordinarily residence test. This is subjective and considers whether South Africa is your habitual home. It is very complex. There's lots of nuances that go into it, but in short, that's what it is. Secondary is the physical presence test. This one is a lot more objective and is based on the number of days spent in South Africa. Generally, if you're in the country for 91 days or more in the current tax year, and for more than 91 days in each of the preceding 5 years, then you might be considered a tax resident. They're both complex tests and need to be assessed with caution and applied correctly when determining your tax residency. The ordinarily residence test is considered first and the physical presence test second. In basic terms, if you have a permanent intent to reside out of South Africa, then you will most likely be able to seize your tax residency via the ordinarily residence test. The physical presence test is most likely something that would be used for people that are coming to South Africa for the first time from overseas. When you're considered a tax resident in two jurisdictions, because that can happen as well. So say you live in China and you left South Africa, you might be tax resident in both. Then in that case, we make use of the double taxation agreement between those two jurisdictions, if there is one, to then decide which one will have taxing rights on you. Typically, each of these double taxation treaties or agreements, DTAs as they're known, there is an article in them, a residency article, that will help resolve the issue of which country has the primary taxing rights over your income. For example, imagine that you're a tax resident in both South Africa and France. According to the DTA between France and South Africa, they would determine your residency based on an if test. So if you meet the first criteria, then they decide which country has taxing rights. If you don't, you move on to the next one. This is what a typical one would look like. The first test would be, so this is according to South Africa and France one. A lot of them are similar, but each one is different. The first would be permanent home test. So if you're a resident where you have you'll be considered a resident where you have a permanent home available. Now the word available doesn't necessarily mean a home you own. It could be a home you rent. It could be a cousin's home that you're allowed to stay in. So it's broad. If you have a permanent home available in both countries, then we'll move on to the next test, which will be the center of vital interest test. Then, according to this one, residency will be chosen based on which country your key personal and economic connections are stronger. If, again, it's in both, so say, for example, you have maintained certain financial interests or a company in South Africa, and your main job is in France, you have family on both sides, this will then equalize. So we move on to the next test, which will be your habitual abode test. That is where you spend most of your time. All right. But again, let's say you love the summertime and you want to spend August, July, and June in France, where it's nice and sunny, and then you come back to South Africa for the December and Christmas holidays to keep maintaining your tan, then it will still be unclear. So you would move on to the next test, which would be usually a nationality test, where they would look at things like your citizenship. If again you have your passport in both countries, then it would eventually move to a mutual agreement where both revenue services would have to decide on which country will have first taxing rights. All right, throughout this webinar, what we're going to do is bust myths or misconceptions that have to do with tax residency. The first one we're going to talk about is a common misconception, which is that renouncing your South African citizenship automatically makes you a tax non-resident. That is not true. You must still meet the criteria outlined in South African tax laws to change your tax residency status. And like I said earlier, a formal notification to SARS needs to happen, and the submission of required documentation is necessary, and then SARS will issue you with a certificate stating you're tax non-resident. If you don't formally break it, you're still tax resident. So you could have given up your South African citizenship, but not broken tax residency. It's important to consider that and have a look. Or you could be a citizen and have broken your tax residency. They're not aligned together. We're not a citizenship-based tax system like the States. Right, let's move on to double tax agreements. DTAs, as they're known, they're crucial for anyone earning income across borders. What exactly is a double taxation agreement? It's really a treaty that has been drafted between the two countries that is aimed at preventing the same income from being taxed twice. That sounds straightforward, right? But here's a catch. Double taxation agreements don't automatically apply. Just because the DTA does exist between your countries that you're in, it doesn't mean that you're automatically protected from double taxation. You often need to apply or claim the benefit under the DTA when filing your tax returns. And on top of that, local tax rules might actually override the DTA in certain situations and limit the application of the DTA. For example, even if a DTA limits or eliminates withholding taxes on certain types of income like dividends or royalties, the local tax laws might still require you to withhold and pay taxes up front before you can apply for a refund or reduction based on the DTA. South Africa actually has quite a good amount of agreements with a lot of countries. We have double taxation treaties with about 42% of the world's countries. These treaties are designed to make cross-border taxation smoother, but you still need to navigate the specifics for your situation. In countries where there is not a double taxation agreement, so the rest of the countries that we don't have one with, there's still a unilateral relief that you could potentially use to minimize any double taxation. So while the DTAs are incredibly helpful, they require some work to ensure you're taking full advantage of their benefits and applying them correctly. Okay, let's dive into how to protect your foreign income from SARS. As mentioned already, as a tax resident in South Africa, you are generally required to declare and pay tax on your worldwide income. However, there are specific exemptions and allowances that can help reduce your tax burden on that foreign income. The first one is the foreign employment income exemption. Okay, if you're a South African tax resident that provides services abroad, so you're employed abroad, you may qualify for an exemption under Section 10102, as is known. Now, there's certain criteria you have to meet. You have to be working outside of South Africa for more than 183 days within a 12-month period. So not just the tax year, it can be a 12-month period, a 12-month running period. You have to make sure that 60 of those days are continuously out of the country. There is a caveat that it has to be an employer-employee relationship to be able to qualify for this exemption. So it doesn't apply to sole traders, independent contractors, and such. So what this happens is that this will exempt your foreign employer-employee earned income up to 1,250,000 rand. Okay. Taxation will happen still for anything above that money, okay, above that threshold. Any foreign income that exceeds the 1,250,000 rand will be taxed in South Africa according to your normal tax tables for that relevant tax year. Now, you have to apply for this on your tax return, okay? You can't just assume that it will automatically happen. You have to put it in your return and claim for it, okay? Additionally, there are other reliefs for foreign tax credits. So, for example, you've paid income tax in your other country. South Africa will allow you to claim a foreign tax credit. The credit is generally limited to the lesser of the foreign taxes paid or the South African tax payable on that income. So it might not cover you in full. There are other types of exemptions for specific types of income. For example, there is the exemption for entertainers and sports persons. There's a pilot's income exemption and a seafarer's income exemption. It's always good to check with a tax professional to see if you qualify for any of those and make use of them. Then the biggie is, if you want to protect your foreign income from SARS, is to break your tax residency, to become tax non-resident. Because if you break your tax residency with South Africa, then all of your foreign income is exempt. It's out of the scope of tax in South Africa. You don't even have to declare it to SARS. Okay. Let's move on to our next myth, right? So one of the myths or misconceptions is that if your income is below that 1,250,000 rand threshold, you don't need to declare it to SARS. You just leave it be and you carry on. Unfortunately, that's not the case. Like I said earlier, even if you qualify for the exemption, you still need to declare your income to SARS and claim the applicable exemption. Right, let's move on to how to seize your tax residency. Seizing your tax residency in South Africa, also known as tax immigration, financial immigration. There's lots of terms in the market, but the idea is you become tax non-resident. This can happen through different mechanisms, either as a one-time event or through an annual assessment, which often is guided by the double taxation treaty that would fall for your jurisdiction. The once-off would be known as financial immigration, generally in the old terms, but let's call it once-off seizing your tax residency to be more accurate. The criteria for the once-off is very subjective. However, a permanent intent to no longer reside in South Africa is one of the main criteria. It is crucial to inform SARS about the change in residency status, as the burden of proof, the responsibility of proving and changing anything, falls on the taxpayer. Therefore, your status only changes once an application is formally made to SARS with the necessary evidence and then is approved. Tax implications. After seizing your tax residency, foreign income will no longer be liable for tax or need to be declared to SARS. But local income must still be reported. So anything South African will still need to be reported. So say, for example, you've broken your tax residency, your main income is from your employment, salary, and such in Australia. However, you still have a property in South Africa that you Airbnb out. That Airbnb income will still need to be reported to SARS, but your foreign salary will not. Seizing tax residency, the once-off way, will also trigger tax consequences like a capital gains tax on asset disposal. So proper planning is essential when applying for this once-off way. Then there is the other way to break your tax residency, which we touched on a little bit earlier, which would be making use of the double taxation treaty between your new country and South Africa to break your tax residency annually. So this happens that you're breaking your tax residency for that specific tax year, and then you continue to do so annually. The main point of this is that you can break your tax residency temporarily for each tax year. The criteria for this is generally that you have moved abroad to live and work, but will be returning after a set period. You must be able to meet the residency requirements set out in the article of the DTA between the two jurisdictions, and you have to be a tax resident in the other jurisdiction to make use of this annual method. Again, to apply it, you would need to notify SARS annually about the temporary change in the residency. Similar to the permanent cessation, annual changes in tax residency can result in tax liabilities like capital gains tax. When using the DTA, navigating the treaty provisions between South Africa and the country is crucial for compliance. You need to ensure that you're applying it properly each year that you do so. Right, what you see on the screen is an example of a tax non-resident confirmation letter from SARS. This is what you would receive when you break your tax residency with South Africa. This document will be crucial in proving your non-residency status to other jurisdictions, or when wanting to withdraw your retirement annuity, receive inheritance abroad, and many other things. What you can see on the screen, highlighted in blue, is it states the date at which you seized your tax residency with SARS. So from that date, then you are treated as non-resident. It's also important to note that it also mentions that any changes in your status must be notified to SARS. This next slide and screenshot is an example of for the foreign tax residency certificate. This specifically is from the UK, from His Majesty's Revenue and Customs. This certificate will be essential for confirming your tax resident status in that other country. It is usually requested when you break your tax residency annually. Like we mentioned with the DTA, you need to show that you're tax resident in that other country. They might also request it when you break your tax residency the once-off way. Now, it's not in legislation that you need to prove your tax resident elsewhere when you do the once-off way because you're using the ordinarily residence test. However, SARS, as a requirement, is requesting it in most cases. All right. The other time you will need it is when you want to withdraw your retirement funds from South Africa. The policy providers will request this. And then we will speak about this a little bit later, but also when receiving your inheritance out of South Africa, you will need to show this. Right, let's move on to our second poll. I will launch it now. All right, the question for all of you at the moment is, have you been submitting any tax returns to SARS since you left South Africa? You can choose either yes, I've only submitted South African sourced income, yes, I've submitted my worldwide income, or no, I have not submitted anything to SARS since I left South Africa. Please, if you could all take part, we'll give it 30 seconds or so. Don't be scared to answer. We won't hold this against you in any way. SARS won't know. It is just for us to just see out of interest how people are treating this. Right. As far as I can see, 63% of you said no, you have not been submitting anything to SARS since you left. 25% of you said you have submitted, but you've only declared your South African sourced income, and 13% of you said you've provided your worldwide income to SARS. Thank you for that, everyone. As we mentioned, it depends on your circumstances, what your status looks like with SARS, on how you would need to submit and what you'd need to declare. But it's something you can reach out to us and we can assess with you as well. Right, let's move on to drawbacks of ceasing tax residency. So as we mentioned, the great thing about breaking your tax residency is that then you don't have to declare and be taxed on any of that foreign income. All right. You don't worry about exemptions or anything else, tax credit, things like that. Your foreign income is fully protected if you're non-resident. Now, as with all good things, there are certain drawbacks. The first one and the biggest one we will talk about is the exit tax. In South African tax law, Section 9H, not that any of you really interested in tax jargon, but just for reference, that Section 9H outlines the tax consequences for individuals who are considered to have disposed of their assets and reacquired them on the same day, the day before you break your South African tax residency. This is what we refer to as the exit tax. Okay. For the exit tax, an individual who becomes non-resident due to immigration is deemed to have disposed these capital assets at their market value on the day before you break your tax residency status. At the same time, you're deemed to have reacquired them at that current market value again. This creates a capital gains tax event. It also sets a new base cost for future capital gains tax calculations. Now, the reason for this is that as a non-resident, so when you break your tax residency, you will no longer be liable for capital gains tax in South Africa, even on South African assets, excepting South African-based property and SA property-rich companies. That means nothing else will be considered for capital gains tax in South Africa. And because of that, SARS wants their part of the gain earned while you were tax resident. Assets that would be considered for this exit tax. Basically, this deemed disposal, this exit tax will apply to worldwide capital assets, not just South African assets. So anything you hold at that point that you break your tax residency, be it a foreign property, be it a trust abroad, a South African share in a business, anything like that. So things like foreign property is considered, shares in companies, interest in a discretionary trust is not considered, but interest in a any other trust might be. Cryptocurrency, shares, stocks, bonds. What it does exclude is South African immovable property, retirement vehicles, cash, and personal use assets. All right. In some cases, you can plan your optimal date of ceasing your tax residency to help minimize this exit tax, because you can imagine it can get quite hefty if not planned correctly. For example, if you only acquired capital assets after you left South Africa, you might want to go back and break your tax residency to the date you left South Africa to avoid them being in the scope of the exit tax. Again, consult with a professional and see if that would apply to you, if you can make use of such backdating aspects. Okay, right? When you break a tax residency in South Africa, not only does your tax status change, but your banking status changes to non-resident as well. Some of the main challenges faced in banking for non-residents are some restrictions. So when you break your tax residency, you'll be able to access your local banking services for online banking fully for local South African transactions, where you get not restricted, but perhaps change of platform would be when you make any foreign transactions or payments, then instead of logging in online to your banking profile, you now instruct a banker from the non-res division of your specific bank, and he will transact on your behalf. So it's more the platform that changes. not your access to doing so. You can transact out of the country. You just need to instruct someone from the non-res division to do so instead of you doing so yourself online. The online banking for the South African stuff remains the same. Debit orders go. I think even your bank account numbers stay the same. All of that stays the same. Also, most of the banks, each bank has different rules, but most of the banks now will not allow you to have a credit card or an overdraft on a non-resident account. Then the other restriction, the third restriction or limitation, let's call it, that comes about when you become tax non-resident is about remitting funds out of the country, taking money out of South Africa. So South African tax residents have an allowance of up to R1 million per annum when transferring funds abroad. This is known as the single discretionary allowance. Okay. However, non-residents are obligated to obtain an approval for international transfer clearance PIN, known as the AIT PIN. It was previously called the FIT, Foreign Investment, FIA, Foreign Investment Allowance. Now it's changed to the AIT. This is a clearance certificate that SARS gives you that you can take funds out of the country. So if you're a tax resident, anything above your million, you need that clearance certificate to take money out. If you're non-resident, this applies from cent one. Okay. The process to get the clearance certificate from SARS is not complex. It mostly requires documentation of your liquid funds and information on where you will be transferring the money to. The certificate can be valid for up to 12 months, which will allow you to transfer the money out at your chosen date, which can be useful when trying to optimize the exchange rate differences. Another thing to note is that for both tax residents and non-residents, anything above 10 million rand out of the country requires Reserve Bank approval as well. When seizing your tax residency, though you do receive a travel allowance, so that tax year you break your tax residency on, you receive a travel allowance of R1 million in that tax year to take out the country that you don't need an AIT for. All right, let's move on to our next myth. Okay, the common misconception that we're going to talk about is that you cannot keep any assets in South Africa when you break your tax residency. So when you become non-tax resident, people think you cannot keep assets in South Africa. That's not the case at all. You can have assets, you can have liabilities, you could have businesses. There's no restriction on that. You can open up a business, buy a property to rent out, a holiday home, you can finance the car. You can have a bond on the home if you want. You can keep a medical aid. You can keep trusts. You can open pretty much anything. It doesn't restrict you from that. And also, your citizenship does not get affected by this either. Okay, let's move on to the benefits of breaking your tax residency. It's not all doom and gloom. The biggie is that there is no tax on foreign income anymore as a tax non-resident. It is fully protected, your foreign income, from SARS. So that's the biggie. That's the great thing, especially as most people's income is from their new country. Now, the next one would be that you can withdraw your retirement policy in full when you're tax non-resident. It used to be straight upon breaking your tax residency, you could withdraw your retirement annuity in full. As many of you probably know, but let me explain anyway, in South Africa, most of the policies are locked in until retirement. And even now with that, there's a change that came about that says you can withdraw a third when you retire, and the other 2/3 you kind of reinvest in another annuity. In very simple terms, obviously there's different complexities on each policy and policy provider, but that's a basic one. Now what happens is when you break your tax residency and you have 3 years of being non-resident, you can withdraw your retirement annuity in full before or after you retire. Either way is fine. There is a tax that you'll pay on withdrawal. If you withdraw before retirement, you only get, I think it's about 27,000 tax-free. If you withdraw after retirement, you get about 500,000 tax-free. But that's something that you would outweigh as a personal circumstance to see what works better for you. Some double taxation treaties actually allow you to choose to be taxed in your new jurisdiction on the withdrawal of your retirement. So it's good to consult with a practitioner, tax advisor, to see if that will be more favorable in your case or not. The other thing that is a benefit is when you inherit in South Africa, you can receive your inheritance straight abroad if you have broken your tax residency and you have that letter. You can show it to them, and then they can pay you out straight abroad. And finally, not finally, the next one is that there's no donations taxed for non-residents in South Africa. As a tax resident in South Africa, there's donations tax that applies. If you gift someone something or donate above 100,000 Rand in a tax year, you start getting taxed on that donation. Now, when you're non-resident, that no longer applies, meaning you can gift and help out as much as you want to your mom, cousin, sister, friend left in South Africa. And there's no donations tax on that, which is greatly helpful. And then the last one benefit I'm going to talk about today is the deregistration from SARS. That's we refer to it as the final breakup with SARS. So when you're non-resident and you have nothing left in South Africa, not even a bank account, then you're actually able to completely deregister from SARS. All right, which is great. You don't have to speak to them. You don't have to file any returns. Wonderful. What I will say is, please, if you're considering perhaps receiving inheritance one day from South Africa or reinvesting in the country, or you want a credit card in South Africa because it's easier to rent your vehicle when you come on holiday, then consider not deregistering because it's a lengthy process. And then to re-register you as non-resident is again another administrative burden. But again, it is absolutely possible if that's something you want to do. Okay, let's move on to other considerations and foreign tax obligations. The first one I want to talk about is non-compliance risk. So be it that you didn't know you had to file a return, you didn't know you had to declare your foreign income, you forgot to, you chose not to, whatever the reason, as I said earlier, the burden of proof, the responsibility to declare, submit, do anything lies with you, the taxpayer. So you're kind of seen as guilty until proven innocent. So this non-compliance risk comes in that if you have not submitted a return, have not declared correctly, have not changed your status correctly, eventually non-compliance can turn into a criminal offense, which can affect your visa status. There are also things like penalties and interest to consider, which will definitely be a financial burden as well. Then let's talk about foreign jurisdiction rates. Be cautious of favorable foreign tax rates to avoid complications with South African tax residency. For example, we've got the Spanish Beckham law, which will allow for expatriates to apply to use a lower tax rate of 24% and not pay capital gains tax on any of their foreign assets. Or there's the UAE that doesn't have income tax. All that sounds wonderful. You know, you'll be paying less tax or no tax. But if you have not broken South African tax residency and have not protected your foreign income from SARS, those favorable tax rates would be pointless if you still need to pay tax on that foreign income in South Africa. Another thing to consider is when leaving other countries to perhaps move back to South Africa or go elsewhere, is to ensure you cover your tax status there properly as well. For example, well, I say this because, like I said earlier, the United States and Eritrea are the only two countries that are citizenship-based. Very few are source-based. So most countries are tax residency-based, so therefore it's something to consider in them as well. So for example, let's say you're in Australia and you decide to come back to South Africa, or you go from Australia to Europe, you must take caution because Australia also has an exit tax similar to South Africa, considering capital gains when you leave Australia. Then places like the UK, they have a split year treatment that you can make use of. So you can choose to be a tax resident for only part of the tax year, which would align your entry or exit from South Africa. If you don't apply the split year treatment, you'll potentially be liable for worldwide income in two jurisdictions for the entire tax year. And tax years in each country are very different. The UK has April to April, South Africa has March to February. A lot of places, like the States, have January to December. So these are things that you need to consider and think of. Okay, and then let's move on to our last topic for the day, which is returning to South Africa after emigrating. The first thing I want to talk about, which has been the topic all along, is resident first and non-resident status. It's important to ensure that you're correctly classified with SARS to avoid any tax complications. Let's say, for example, you left South Africa 12 years ago and you have been living in New Zealand ever since, and you intended to not return to South Africa to live at all. Right? So New Zealand was going to be your permanent home. You've been there for 12 years. Wonderful. However, due to the new visa changes that were implemented in New Zealand, you no longer qualify to remain there, and now you need to return to South Africa. When you return, SARS will question what you have been doing for the last 12 years and why you have not been declaring your foreign income to them, as you're still noted as tax resident. This will bring about a slew of negative consequences ranging from double taxation, late penalties and interest, non-compliance, and like we said, potentially even a criminal offense for not having complied. Then the second thing I want to chat about is navigating the residency tests. So basically making use of our South African tax residency tests to plan your return and how you will reestablish yourself as a tax resident. It's favorable if you can do this strategically, as you can optimize tax savings. You can make use of the physical presence test and ordinarily residence test to plan your new date of becoming a tax residency and potentially save a lot on tax. Speak to us or another tax professional before moving back to South Africa or before making any changes or declarations to SARS. It is also vital to plan how you will break your tax residency with your other jurisdiction and what would be the most favorable way going forward. All right, we're now going to put up our last poll. Please, if you could all take part. This one is asking if you guys would be interested in a specific breakout session for your country. So let me know if you guys from Australia or Ireland or wherever you are would like a country-specific session to discuss more how the two jurisdictions work together and other benefits. And if you would like a free 50-minute consultation with one of our tax advisors. Please, if you could say yes or no, I'll give you guys about 30 seconds. Wonderful. Thank you all so much. Right. Let's move on to how we at Sail International can help you. We offer a range of services, including things like tax health checks, which can determine your tax residency status and compliance with SARS. Then we can also do a tax residency opinion, which will assess your South African tax residency and your other jurisdictions' tax residency status according to the specific legislation. We can help with, of course, breaking your tax residency with South Africa to formalize your non-residency status. We can advise on which date would be best to do it on. Do we backdate? Do we do a current? How we would plan that for you. We can help with a AIT clearance certificate to be able to remit your funds out of South Africa. And we can help really with any cross-border tax matter, be it with South Africa or any other jurisdiction. We also provide a free 15-minute assessment or consultation. We will circulate and send out a link to book for this free assessment. And we will also circulate our South African Tax Residency Handbook, which you can read a little bit more about all the stuff we discussed today. Great, thank you all so much. Let's move on to our question and answer section. We'll open the floor to any questions you may have. Please feel free to type them into the chat, and we'll address them shortly. Right, let's have a look at what questions we have. Right, our first question is, can you touch on the effects of being a tax non-resident in South Africa, but a beneficiary of a South African trust? Great, that's a really good question. Trusts are notoriously known for being used to protect assets, minimize tax. However, in the last decade or so, globally, revenue services have kind of clamped up on them, and they're not as tax efficient as they used to be. However, they're still great tools to plan your wealth and assets. So being a tax non-resident in South Africa and a beneficiary of a trust will firstly affect when you break your tax residency. If it is a discretionary trust, it will most likely be out of the scope of the capital gains tax, the exit tax. But if it is not a discretionary trust, then it will fall within that scope. So there might be an exit tax to consider there. Then the trust itself, if you and most of the trustees and things like that are become non-resident, it might change the residency, the tax residency of the trust itself. So it's important to consider things like that as well. Right, so let's go on to our next question. It says, oh, that just was asking how to participate in the poll. Okay, let's see any questions in the chat box. Right, let's see. So here we have one. If I left more than 12 years ago, how do I even know what is required with SARS? Also, to get the letter saying I'm not resident, how long does this take? Okay, that is a great question. So if you've left 12 years ago, 5 years ago, 2 months ago, the process is the same. What we usually do is we dive into your SARS profile, your e-filing profile. If you have one, if you don't, we can help you create one. And we basically do a tax health check. That's what we name it, but basically it's an audit of your SARS profile, which will show us, are you compliant? Are you non-compliant? Are you resident or non-resident? How does SARS see you? How does SARS perceive you? And it will tell us what's necessary then to get you compliant, to be able to submit and break your tax residency. The process itself of breaking tax residency, it will be the time to get all your documents together that's needed. And then it will be usually, SARS gives a turnaround time of 21 working days. However, they can approve it or decline it or whatever the case is within 2 days, 2 weeks, or take longer, in which case then we escalate. But a rough estimate would be, let's say, about 2 months. Okay, we have another question. May we have a copy of this presentation to download? Yes, we will circulate the recording and the copy of the presentation in email after the webinar. Then we have another question. Could you apply the DTA before the Section 10102 exemption? So either of the two. Yeah, so the two are completely separate. The Section 10102 exemption, that 1,250,000 Rand exemption of your foreign income, that is used if you're a tax resident in South Africa, working abroad for an employer, and you meet the criteria. That is then used to declare your foreign income and exempt up to the 1,250,000 Rand. The DTA would be made use of to break a tax residency in full for that tax year, meaning that not just your foreign employment income, if you're self-employed, independent contractor, that income will also be protected. But again, you'd have to meet the criteria. So that's how those two are separate. Right, then let's see one more question. I have left South Africa in 2009, have been declaring South African rental income on SA tax return and all on UK tax return. Law changed after I left. Okay, yeah. May I be subject to penalties for the last 12 years I have not applied for residency break? Okay, so potentially yes. We'd have to see your situation, but on a generic advice, I would say that because you've only been declaring South African rental income and you're still a tax resident, you're technically non-compliant, as you should have been declaring your full worldwide income. However, if you meet the criteria, and we would assess this, but if you do meet the criteria, we could potentially backdate to 2009 and break your tax residency then, hence making it correct the way you declared only South African income, because you would have been non-resident as of 2009. So please, if you feel free, book a 15-minute with us. Let's assess, let's discuss, and see how we can help you. But let's say you didn't break your tax residency, then yes, there will be penalties and late interest for not declaring your worldwide income as a tax resident. Right? Two more questions, and I think we can wrap it up after that. Can one take advantage of when they seize tax residency to minimize their capital gains tax, i.e., not only on the date when one leaves South Africa? They've put a note, the majority of assets are still in South Africa. Absolutely. You can plan on which date you break your tax residency. You'd have to obviously have the evidentiary support to do so. However, yes, you can absolutely plan on how to do this to minimize the exit tax if possible. Again, the type of assets that will be considered, the majority assets in South Africa, most of them will probably be included in this exit tax, except for things like South African property or property-rich companies, any retirement, annuities, cash, personal use assets. But you can absolutely plan for when there is a loss or a lower gain and see if you meet the criteria to break it on that date to be more favorable. Right, then the last question. Could the DTA not be used at all if you stay a South African tax resident? So only if you're a non-resident breaking tax residency out of South Africa. So if I understand the question correctly, if you remain tax resident, then there's no need to make use of the DTA to break your residency, but you can make use of it for other things. For example, you stay tax resident both in the UK and South Africa. Living both sides, enjoying both sides, you're declaring in both sides, but you decide, I want to withdraw my pension in full now, I've retired, whatever the reason might be, you meet the criteria to pull it out, maybe it's before the change of the two-part retirement system. You can make use of the DTA then to say, I want to pay my withdrawal tax in the UK because I'm also tax resident there, and not pay it in South Africa. Let's pretend the UK tax rate for withdrawals was more favorable. It's not, but let's say it is for this purpose of this example. You could choose to be taxed in the UK and not South Africa for the South African withdrawal because you would meet the criteria and, as per the DTA, break it enough to be tax resident in the UK for the purposes of this. I hope that answers your question. If you have any others, please feel free to email us, book a 15 minutes. I see Melissa from our team has put the link in the chat, but we will circulate it on email as well. Great. Thank you all so much for joining us today. I hope it was insightful and useful. Have a lovely day.